Good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, please confirm in the chat box by typing yes or typing in 111 in the chat box, or share an emoticon if you can hear me clearly, so that I know everything is well on your side and you are able to listen to me. Great, thank you very much. Now, today's Let's Learn Futures webinar topic is the final topic for year 2024. And the topic today is unlocking trading success with diverse styles and time frames. This LLF webinar series is proudly presented by Bursa Malaysia in collaboration with Excellent. I'm CY Saw, your moderator for today's session. We are privileged to have Jose Blasco joining us to share about what are the differences of trading styles and timeframes you can unlock for trading success. I see more people have just joined the webinar room. Welcome. And before we begin, let's do one final sound check. Please type in 222 or yes, or give us a thumbs up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. Great. To ensure you have the smoothest and highest quality video experience, I highly recommend turning off your video camera during the session, as this will help ensure that everyone can enjoy uninterrupted webinar and have an optimal learning experience. Today's session will be divided into two parts. In the first part, Jose will present his sharing. Following that, we will be having a Q&A session where you can ask questions related to today's webinar topic. And as you may have already noticed, there are some new improvements in this webinar platform interface. So to ensure we can address your questions effectively, please follow these two steps. Step number one, you need to find the button, Slido button, somewhere on the lower right if you're using a laptop or tablet. Click onto it and there will be a message bar popping up. And step two, you can type in your questions in the message box as shown in the image number 2 here. And please note that due to the high volume of messages in the chat box, it may be challenging for me to spot your questions if you don't use Slido for Q&A. So feel free to type your questions in Slido box at any time during the session. This is the LLF Let's Learn Futures online workshop. It is specially designed for those of you who are new to futures trading. And in this workshop, we cover a full set of beginner's knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. And each session is 3 hours long. So it would be a whole day workshop, morning 3 hours and afternoon 3-hour session. As you can see here, this upcoming Saturday, 30th of November, is our final LLF online workshop session for year 2024, conducted in English. So if you're new in futures trading and would like to learn more, you can register for these online workshops, as they are entirely free and fully sponsored by Bursa Malaysia. And please note that the attendance is limited to the first 50 online participants, so be sure to grab your seats quickly. Before we begin, it's my pleasure to introduce our speaker for today, Jose Blasco. Formerly, Jose was an engineering professor in Spain. He is also an award-winning trading instructor. Jose is a multi-asset and strategies trader who trades globally. Besides that, he is also a quantitative researcher where he produces commentaries across different markets. He develops advanced trading models and implementing hybrids and algorithmic trading system. He's the founder of Tradictive, which have been developing patented trading technology and teaching clients on this trading technology. So without further ado, let me pass this presentation over to Jose. So Jose, the floor is yours.
Okay, so welcome everybody to the session. My name is Jose Blasco, Unlocking Trading Success. I guess we like that. How do we do this? Diverse styles and timeframes. What does that mean? Well, here's the beauty of trading and financial markets. There are many things in the marketplace that obviously we have no control about, such as you get into a trade, and then the market will do what it needs to do. But there are other things that we have full control over it, things such as risk, how many contracts we execute in a trade, for example, or in this case, and today we are talking about your trading style, which is very much related to the type of time frames and the various time frames that you will utilize in your trading. You decide that. Okay, you decide that, and obviously such decisions could certainly lead to greater level of success, especially when we make our trading to be compatible with our life, other components of our trading activity, and so on. For example, let's say you want to trade a time frame that is not compatible with you because maybe you're a very busy person, or maybe you are not a patient person, and you were to use the wrong time frame. So now you are implementing the wrong style of trading, and that would not lead to success. So the idea today is to have a conversation around this concept more in depth. I will be using a collection of slides to cover some of the theory part of the topic, but then of course I will be jumping into live charts as well to do some live demonstration of what we are learning, which hopefully helps and may raise some questions from your end, which I will then clarify when we get to the questions. Very good. So disclaimers, as always, in a financial presentation, we always have those, isn't it? So very simple. We are here to learn. So this is an educational presentation. I will certainly be utilizing real financial products such as FCPO, FKLI. Those are tradable products. The fact that I utilize them into this presentation does not mean that this is a financial recommendation or advice. It's educational purposes, and this is precisely the topic or the concept of today's presentation, that we need to make our trading our own style, right? So again, please use this training for that purpose, and ask many questions. So as the session concludes, you would have a better understanding of what's next for you when it comes to defining your style, in case you haven't done it yet, or if you already have decided what type of trader are you are. So hopefully this session helps to solidify that critical decision. So we're going to spend the first part of the session on basically clarifying everything that has to do with styles. We'll talk about time frames, we'll talk about styles, we'll talk about aggregating time frames, and then at the end we will have Q&A. Myself, as I said earlier, CY has been extremely kind to me with the introduction. Long story short, I am a trader. I utilize those markets, and what that means is that I implement what I'm about to discuss today in the format of styles of trading. I implement that in multiple ways because I am actually a multi-style trader, whereas in certain accounts I may execute trades of a shorter duration, let's call it intraday, where in other accounts I may perform what could be called investing, long-term investing, which is in the complete opposite extreme, if you wish. And of course, anywhere in between, there are also different various possibilities, which I also implement in the marketplace. So we're going to be talking about all of those, the pros and the cons, how should that be done, and hopefully this helps you very much. So first of all, we need to talk about the time frames and their implications when it comes to your style of trading. So the good news, as I already mentioned, is that the time frames are chosen by the trader. So there are certain things that we have control of in the marketplace. There are certain things we cannot control. Choosing the time frame, it's your decision. You may decide that you're trading FCPO on a 5-minute time frame. You may decide that you're trading FCPO on a 1-hour chart. You may decide that you are maybe hedging FCPO using a weekly time frame. So again, all is possible. There is no right or wrong. It's all about your plan and having a reason behind that decision on which time frames you have selected and why, and what is the purpose and what are you trying to accomplish. Okay. The time frames, they basically refer to the lifespan of each candle on a chart. So for example, here, if I bring a chart of FCPO, for example, so we have here an 8-minute time frame of FCPO. This is obviously nothing new, but that means that each candle is 8 minutes. So if instead of 8 minutes, I make it 1 hour, now each candle is 1 hour. And what is the direct impact of this? The direct impact is that the longer the longer that I am going to be, let me rephrase this. The longer the time frame I utilize when I analyze and apply my trades, well, the longer the duration in minutes and hours or days or weeks my trades are going to last. Okay, this goes hand in hand with the definition of a trading style from an activity point of view. Are you an active trader? Are you a passive trader? Are you somewhere in between? It's a critical decision in your trading, putting on the side that you could be a multi-style trader and perform different styles. But it will not be advisable to mix and get confused across timeframes because we keep changing hat during the plan of a one specific trade. So we should be one style of trader with a specific set of timeframes until the trade is planned and executed, and then it's okay to change hat and go perform a different style of trading. But we should keep some structure and a systematic approach on how to implement our trading methods, isn't it? So styles of trading are decided by a trader. They refer to the type of trade based on its desired duration, and it depends on the trader's personality, availability for time, as well as goals. So for example, let's talk about personality. Let's say you are not a patient person. And let's face it, all of us, 100% all of us today meeting in this webinar, 100% all of us, and that includes me too, we have strengths and weaknesses, both. No one only has strengths, no one only has weaknesses. We have both. So it's very important to be self-aware of who you are as a trader and design your trading approach based on that. For example, going back to what I was saying, let's pretend that you are a non-patient person. That's your trading personality. Well, utilizing a very long-term time frame, such as a weekly time frame, something like that, where to get to your target is going to take multiple weeks. That's going to make you a very slow-moving trader. And because you're not patient, well, probably you just open the door wide open to psychology impacts in your trading, where somewhere in the middle of the trade, you will decide something, you will improvise exiting the trade just because, and just because really is you're not a patient guy, if that was your case. So it's important to look at ourselves in our mirror and based on those particular traits, in this case, personality, decide what's the ideal style for me. So if I'm not patient, maybe an active style of trading where from entry to exit, it takes maximum an hour, maybe ideal, be half a day, maybe ideal. Availability for time, of course, that has an impact too. So let's say, for example, that you are a person who trades later in the day or early in the morning before you go to work because maybe you have a job, but you do perform some trading before you go to the office. Well, obviously, you cannot be utilizing maybe the daily time frame. It would be a bit too lengthy, isn't it? Because it would take multiple days to be in a trade where you only have a few hours before you go to work, if that was your case. So again, all of those various criteria are important to take into consideration when deciding the type of trader that you want to be. And once all of this is decided, you then go ahead and pick timeframes that are going to make you trade with that particular level of activity, meaning very active, or actually lack of activity, meaning more on the passive side. It's a very important question that I've seen it many times that traders trade just because they've seen someone do it in a particular manner. Maybe they read a book and the chart examples in the book were using the 5-minute time frames or 30-minute time frame, you name it. And next thing you know, the trader is doing that style of trading with those particular time frames just because that was on the book. Nothing wrong with the books, but the question is that in line with you? Is that what you really want to do when it comes from a point of view of style? Okay, so my proposal to you here today is let's think about what's your style first, make yourself compatible with the marketplace, and then find the tools that will make you that style. The tools in this case will be a set of timeframes, which we're going to discuss in a moment. So the style of tradings that are commonly used in the industry are intraday trading, swing trading, position trading, and investing or long-term trading. And you could have mixes, right? So you can have an intraday swing trader or a swing position trader. Again, those are fancy words that basically go from more active to less active, and therefore shorter duration for your trades to longer duration for your trades. So the question is, how long would you want your trades to last? That's an average, okay? Because of course we don't know for sure how long a trade is going to last, but as an average, would you like it to be a few days? Would you like it to be a few hours? Would you like it to be a few weeks? Would you like it to be a few minutes? You know, who are you? What type of trader are you, or are you willing to be? Okay, that's the question. So let's explore intraday style more in depth. So what if you are in an intraday trader? What are you really trying to do here? Well, first, you are trying to capture rapid market movements, in and out, quickly, done for the day. That's the philosophy. An intraday trader is not looking for the best trade of the year, because the best trade of the year only happens once a year. So then you would only trade one time per year. So that is definitely not active trading, isn't it? This is maybe a little bit of not the best type of humor that you have heard, but hopefully you have a bit of a smile on your face, because it's obvious, but often people don't think about it. Always looking for that amazing trade. Well, an intraday trader is not always looking for an amazing trade. He's actually just looking for trades that justify themselves, maybe a 2-to-1 reward to risk ratio, maybe a 3-to-1, maybe 1.5-to-1, depending on the trading plans and how active you want to be. And the moment the trade meets your rules, you go for it. The goal is trades that last a few minutes, maybe a few hours maximum, definitely never more than a day. Not looking for those incredible trades. Instead, one or more trades a day, done for the day. That's the philosophy. And of course, you can make it a bit more biased toward activity, a bit more biased towards quality. Again, it's within the trading style. You have a little bit of wiggle room to customize it. But bottom line, you just want to trade, and you want to take that at least one trade a day, in and out, done. And if you are more active, you take a few trades per day, fantastic, okay? So what is a normal trading session for a trader of this sort? Couple of hours. Why? Because, I mean, could you spend the whole trading session trading intraday? Of course you can. But it's also opening the room for maybe revenge trading or forcing trades or a little bit of emotional trading. What if your initial trades of the day were losses? Maybe you spend the rest of the day trying to make up for profits, and maybe it was just a difficult day. So you end up the day with too many losses. If you had stopped earlier, it would be better, right? So again, typical rule of thumb is 2 hours. It's an amount of time where we can be very well focused, but also not to start falling into being tired, not to start falling into the trap of trading emotions. So it's very typical, even though it could be a bit more, a bit less as well. Trade size. Well, when you trade intraday and you're trying to capture those reasonable moves that, because they're going to happen in an intraday timeframes, they're going to be small moves. So the only way to produce decent profits out of small moves is to utilize margin, to utilize leverage, and therefore use large trade size, even though it doesn't mean you're using a lot of capital because you trade on leverage. But the trade should be large in most cases, because again, the goal of this trader is to convert a small intraday move into a decent profit. Okay, so if we were to trade stocks, which is not what we're discussing today, but if you were to trade stock where you can trade as little as one share, you would definitely not use one share. You would use many, hundreds. In futures, we use contracts, and even one contract is already quite large. So maybe one is good enough depending on your trading plan, but definitely it could be common to trade multiple contracts per trade, again, depending on your trading plan and your account size. I said it earlier, challenges. Emotions are easily impacted by fast action, which is why I mentioned that 2 hours is a typical thing. Again, a mature, experienced trader with a great self-control level when it comes to trading emotions may trade for longer. For sure, you can also bring in some algorithmic trading into the mix, and then there are even less emotions, okay? But yeah, basically, that's intraday style. So how would that look like? So here's an example out of a 5-minute time frame with FCPO. where in this case, I am using the two techniques I prefer to use in my own trading. Later, I will discuss other techniques as well, because there are many ways on how to trade, and I'm pretty positive that everybody attending the session may have a different way on how to set their rules and validate and approve or discard a trade. In my case, I utilize auto climate that tells me, is it time to be a buyer or is it time to be a seller? And when I know it's time to be a buyer now because it's blue, so then I will go ahead and look at auto UFOs. UFO stands for on-field orders. And when it's green, it means buy on-field orders. And when it's red, it means sell on-field orders. And therefore, if I was this trader at this moment in time, I would be waiting for FCPO to come back to me. I would take a long trade here. That would be my entry. Like that, entry. If FCPO was to keep falling down below my UFO, I would have a stop. So that would be my limitation for risk. And if FCPO was to rally in the opposite direction, the red UFO, which is sell on-field orders, that would be my target. So stop entry target, in this case, risking this amount in order to make this larger amount, like 2 to 3 to 1, something like that. That would be the plan. So what happened in this trade? Worked well. It went into the green UFO, bounced, and went to my target. Congratulations, this is great. The point of this slide is not how beautiful the trade was. The point of this slide is how long it took. So this trade, it was an up trade. The price traveled 39 ticks, which in the case of FCPO is also 39 points. And it took 40 minutes. So in other words, out of a 5-minute time frame, my trading style was a style such as my trades last 40 minutes, in this case. Okay, 40 minutes. So now, what if instead of an intraday trader, I decided to be a swing trader? I'll come back to this slide. So to be a swing trader, what I would have done is use the 1 hour time frame in this case. So instead of 5 minutes, I would use the 1 hour time frame, and I would be doing the same thing. It's blue, so it's telling me time to be a buyer. I have a green UFO, so this is my entry right there, and this is my stop right here, and this is my target up here. So now I'm expecting FKLI, in this case, to come to the green UFO and bounce and move in the opposite direction. And if I'm wrong and it goes against me, I will stop myself out. So I am risking this vertical amount in exchange for that other vertical amount of potential for profit. That's the trade. Okay, so what happened in this trade? It worked well. Congratulations. All the examples on the slide, by the way, I picked them on purpose that they were good examples. So that's not the point of the slide. The point of the slide is, out of a 5-minute time frame earlier, I was trading and my trade duration was 40 minutes. Now I am using a 1 hour time frame. Well, out of utilizing a 1 hour time frame, I caught a 33 tick move, which is 16.5 points with FKLI, and that took 9 hours. So how did I make my trade to go from 40 minutes to 9 hours? Well, very simple. I chose a 1 hour time frame instead of a 5-minute time frame. Who decided about that? Me, the trader. Anyone forced me? Anyone limited me? Any broker limits you on which time frames to use? No. It was a decision I have taken given my account size, trade personality, personal preference, level of activity, how patient I am, etc., etc. Okay, so again, this is an example of a swing trade. Since I skipped a slide, let me go back one slide. And here we can see how the goal was to allow some time to capture longer market movements, so a bit more relaxed. Trades last multiple hours or days, looking to secure significant moves that justify overnight risk. That's an important point, because when you take a swing trade and you're going to be in it for a few hours or maybe a couple of days or so, you may need to go through the gap, the daily gap, from where the market closes one day, reopens the next day. And if you have a gap against you, and plus trading derivatives on leverage, you have a gap with the leverage effect. So that may be very painful, and you may get stopped out for a greater loss than expected at the beginning. So how do you justify taking overnight risk, which may produce a greater loss than expected. Well, you should justify it by making sure that instead of capturing those quick moves intraday, you are shooting for a little bit longer moves, wider profit margin zones. So your reward to risk ratios will be a little better. And in that sense, if you ever have to go through a situation where a gap hurt you, well, then you can survive that because the profits that you collect are decent. Okay. Trade size, you want it to be a bit smaller. Why? Well, because you're going to have more risk. The distance between entry to stop is going to be more because the time frame is larger. So you have more, a greater amount of ticks or points as risk, but also you also have the overnight risk where you may have a gap against you. So to reduce the level of pain, a smaller size, it's typical and critical when it comes to, I mean, if we talk about the name for this webinar, which is success, right? So managing risk is critical for success. So understanding your size per style, it's critical. In other words, maybe an intraday trader trading FCPO or FKLI decides to risk 2% per trade every time you trade, 2% of your account in this case. Whereas maybe a swing trader trading the same FCPO, FKLI, for example, they may decide to risk instead of 2% per trade, 1% only. Why? Because you have more risk from a distance point of view, but you also have the overnight risk. So to mitigate the impact of that, you may reduce the size. Okay. Advantages. Well, now you can trade multiple trades in parallel. So that could add some diversification apart from the fact that if you're right, you profit double the speed. So that opportunity is interesting. Of course, challenges is a bit more complex than managing one trade at a time. And, some traders may decide, I'll just complete this trade and then think of another trade after I'm done and do one at a time. Nothing wrong with that. Even though, certainly for experienced traders, I do understand the willingness to be more active in this sense by running multiple trades at the same time. What if we're going to be a position style trader? Well, it's kind of the same. It's kind of the same as swing trader. It's just everything grows a little bit from the duration and the risk point of view. So smaller size may be more adequate, and the duration of the trades is also expected to be larger. So if I go for the next example, which is a daily time frame on FCPO. Okay, remember the first example, I was using a 5-minute time frame. Second example, a 60-minute time frame. Now I'm using a daily time frame. So I'm going up the time frames, and that is now making me a position trader with a daily time frame. So what am I doing? Doing the same thing. I got blue on my auto climate, so time to be a buyer. Price coming to the green UFO. So this is your entry, and below is your stop. So entry and stop. Okay, and the opposing rival right UFO, that's going to be your target. So the expectation, same as before, I basically selected examples that were kind of like copy paste from each other. So you can see the point of this slide, which is not to show you how beautiful it is when the market moves your way like that, which is beautiful indeed. The point of the slide is to show you that now we made this trade to be a trade where we collected 746 points and the duration was 17 days instead of 9 hours or 40 minutes like the prior examples. How did I do that? Again, I changed my time frame to be a larger time frame, and who decided that? It was me. Full freedom when it comes to this particular decision. Okay, now what about investor style? Okay, well, investor style is down. We take it up even more. So now we are looking for trades that last multiple weeks or multiple months or even a few years. So in certain cases, of course, with derivatives, we cannot avoid leverage. But in certain cases, you may even want to avoid leverage or have a very strong hedging application on top of your trades, because not only are you going to be exposed for the overnight risk one day or a few days, you're going to be exposed to that overnight risk for a few weeks or a few months. So, of course, risk management becomes extremely critical, even though you also have great advantages in your favor, such as, longer term trends that may be the consequence of very strong fundamental shifts in the marketplace that tend to last for a long time. And you may go ahead and catch a 1-year trade or 2-year trade by using a larger time frame, even though, as it says in the bottom part, the challenge will be the patience, right? You have to wait for the right time to get into those very, very much lasting trades. They're not going to happen every day. Okay, that's why they last for so long. So in this case, we are looking at FKLI. So this is a weekly time frame, same story. Again, those examples are selected on purpose. So blue climate telling you being a buyer carries with it a statistical advantage. Green UFO entry and stop, as we have discussed in prior examples. And the red UFO above, that would be the nice place for the target, right? So the expectation would be for FKLI to come to the green UFO and to bounce and to go to the red. And if it goes against you, your stop is waiting for you to limit or manage the risk. Same approach, right? So what would happen if you used a weekly time frame? Well, this trade didn't last 17 days. It took 10 weeks to get to your target in this particular case, okay? Again, I guess it's common sense, and it was clear since I said it on slide 1 or 2, but hopefully those visuals are now making it very, very clear for traders that putting on the side the methodologies that you have been learning throughout the program, there is a key decision to be taken by you, which is what's your style? And therefore, what are your timeframes? Because very likely, the majority of methodologies that have been discussed in this webinar room are very, very likely, many of them applicable to different timeframes. So the question is not which methodology are you going to use when you trade. The question is, which timeframe are you going to use to apply such methodology? Because that sets your style and again, has a direct impact in your level of success, okay? So classical timeframes that are used in many, many cases across the board, and therefore it makes sense to talk about it, are 15 minutes, 60 minutes, 240 minutes, daily, weekly, monthly, and then 3, 5, 15, 60, which I already said 50 and 16, and 15, right? So those are classical timeframes that are being used. Notice that the way they are presented on the slide here, they are presented as larger timeframes, as intermediate time frame, as lower time frames, and these type of time frames come with a style: intraday, swing, and position, and investor, right? So for example, let's say you're an intraday trader, so maybe your analysis focuses on looking at the 15-minute time frame combined with a 3-minute time frame combined with a 1-minute time frame. Maybe that's how active you are. Or maybe you are an intraday trader still, but a bit more, let's call it relaxed, using the 60-minute time frame combined with a 5, combined with a 1. Or maybe now you are more like a swing intraday guy, halfway between swing and intraday, using the 240, 15, and 3. Or maybe now a little bit more, even more relaxed, using the daily 60-15, or using the weekly 4 hours and 1 hour, or using the monthly, daily, and 4 hours. So those are classical combinations that make a lot of sense. Of course, other combinations could be, and they make sense too. So maybe you say, look, instead of 4 hours and 15, I'm going to use 4 hours and 30, or 4 hours and 1 hour. So again, there is no right or wrong. In the end, we're just looking at the market from different angles when we look at different timeframes. Like when I like to use this analogy many times when you go to a doctor because maybe you let's say you felt, hopefully not, and you need an X-ray. Maybe your shoulder is painful, and the doctor, when they take the X-ray, they would typically take the X-ray from different angles so they can look at the same thing from a different place, from a different angle, and conclude, have a confirmation that what the thought they saw is what is actually happening. So the use of multiple timeframes is helpful to be able to have a little bit of an extra confirmation that some market condition is in line with your trading plan and your trading rules and is giving you permission or confirmation to execute. Of course, nothing never will be certainty, just like an X-ray. Everything that is visual could lead to misinterpretation. And on top of that, like an X-ray, and on top of that, anything that has to do with the future, it's still to be seen. Just like, if your doctor sees something on your shoulder, gives you some sort of, an injection to fix the pain or something, maybe that helps you to heal or may not help you to heal, and you have to go back to the doctor in the future. So same thing with a trade. You may have done your analysis, look at multiple timeframes, confirmed and concluded time to execute, and then you got stopped out, or maybe you got a profit. So what comes into the future is what comes later. But being able to do the right type of analysis leading to a potentially valid conclusion is a very good beginning to help your success, and doing that with the right set of timeframes in line with your trading style, where you trade at the right time of the day for you, where you can be relaxed and focused, where you trade the right product with the right time frame, with the stop at the right distance, so your account size could absorb such level of risk comfortably. That helps to lead to success. When you trade a time frame that is in line with your level of patience or discipline, or whatever other personality traits you may have that are impactful in the trading world. So all of these leads to success. So while many of the things I've said in today's webinar may seem or may sound, and indeed are, obvious, the reality is that it's a very healthy exercise, the one we are doing, when it comes to discussing it, and hopefully having some of you think about it. I mean, I would love it that later in the webinar, or if you want to start typing now, and I will read you later, I would love it that if you could type, hey, I thought about this either before the webinar or during the webinar, and I am concluding that my style of trading is intraday, swing, position, long-term, and I'm going to use the time frame 65, you name it. I'd love to see that on the chat box later on when I'm done with the slides, and I take a look at the chat box, and that would be great feedback for me. Very appreciated. If you are open to work with me, engage this way. That would mean a lot, and it would help me to understand if these concepts need more reinforcement as well. So now, in this concept of utilizing multiple timeframes, something very interesting to be done, which is also very much in line with trading styles, is what we call timeframe aggregation. So this involves combining insights from multiple timeframes for a more comprehensive view of the market conditions. So you look at multiple timeframes, and this could help you to confirm a trend condition, for example, or refine your entry and exit points, or some sort of a potential obstacle for the trade to work well. It could help to confirm signals, etc., etc. This is commonly known as top-down analysis, even though top-down analysis could also be other things, especially in the world of fundamentals. But anyway, so take a look at those visuals, even though I'm going to do this live in a moment. But in this particular case, we are looking at FCPO, and I'm looking at a 1 daily time frame, at a 4-hour time frame, at a 1-hour time frame, and at the 8-minute time frame. And you can see that some of the lines I have on the screen were drawn on the daily time frame. Some of the lines were drawn on the 4-hour time frame. Some of the lines were drawn on the 1-hour time frame. And in the end, all those lines are visible on the 8-minute time frame. So I am aggregating what would potentially be relevant price points based on, let's say, technical analysis, classical support and resistance, for example. I am aligning those lines from multiple timeframes into my lower time frame for trading execution, which could be powerful, because if I was to only look at the 8-minute time frame, I may miss some of those lines, given the fact that a lower time frame may produce not only relevant data, but also lots of noise. And therefore, some relevant piece of information may be misunderstood. In this case, again, I'm going to do this live now, okay? I'm almost done with the slides, and I'm going to do some practical application. But here, for example, and this slide looks a little messy, to be honest, with so many colors on top of each other, but that's the point. We have some Fibonacci calculations out of the weekly time frame with FKLI, some fibs out of the daily time frame also with FKLI, and also some more fibs out of the 4-hour time frame also with FKLI, and all of those time frames appear now on the 30-minute time frame, which in this case would be the lower time frame. And notice how some of those Fibonacci lines, for example, look at those two lines are so close to each other. Okay, those two lines are also very close to each other. Those two lines are also very close to each other. Okay, but notice how this fib is alone by itself, that fib is alone by itself. So in other words, those lines that are basically coinciding is what is known as nested fibs and could represent price points in the marketplace which are more relevant, and maybe there could be very interesting and intelligent entry or exit points into certain trades that you may want to execute. You will not have visibility of those particular relevant price points without the assessment of multiple timeframes. So really, timeframes and styles, they go hand in hand because of the concept of trade duration, but also go in hand. They also go hand in hand because of the concept of success. Because by aggregating all that information, you are likely going to be, of course, there is never a guarantee in the marketplace, but you are likely going to be observing something that is more relevant, potentially leading to higher probability trades, higher quality executions, etc. Okay, so again, the title of the seminar, webinar, right? Success. Anyway, this is the final slide I had for everybody. And what I want to do now is basically to kind of like go over some of the key things that we have said, but I would like to do it live with charts. Okay, so here are my charts. And again, we're gonna do an exercise here. First, I'll pick any chart, for example, randomly. I will select, since I used 5-minute time frames earlier, so let me pick the 10-minute time frame, for example, as an idea. Okay, and so here would be my execution time frame. So by looking at what I see on the screen and replicating what I've done with the slides with the UFOs. So if this particular market was to rally to this red UFO, I would want to short and expect the market to go down. If that market was to go down and come to this green UFO, I would want to go long and expect the market to go higher. But the question is, that's great to know your entry and exit points, but is it even time to be a buyer or is it even time to be a seller? In other words, what's the trend? And is the trend likely going to remain the same way it is, or is the trend going to, maybe the trend is at an unsustainable stage, and therefore, while the trend is your friend and is powerful and everything else, maybe the trend is about to reverse. So where are you at in that cycle? Right? Where are you at? So in this case, as you know from what I said before, I utilize AutoClimate, but we also said that it would be a healthy thing to be done is to utilize multiple timeframes. Okay, you utilize multiple timeframes. So what about I take a look at the 1 hour time frame I was going to use, but just to make this a bit more interesting, what about I look at the 2 hour time frame just to widen a little wider. So if I look at the 2 hour time frame, in this particular case, we can see that AutoClimate is telling you time to be a buyer, even though it's too late. Okay, and the reason why I'm saying it's too late, and therefore shorting is probably higher probability, it's because the normal duration of an uptrend is 7 on the 2 hour time frame, and the current duration is 13, which is almost double. In other words, the duration of this move to the upside exceeds what probabilities suggest a normal thing is. I mean, this will happen from time to time, that you have very significant moves that keep going and keep going and keep going. It's very smart to get into these moves early on, so you can potentially collect lots of it. But when you are already in a potentially latest part of this move, probably not a good idea any longer. And that's where we are now. So these may continue a bit more, but then it may start going down. And this is basically what I am assessing by not only looking at the color of the dots, but also looking at this number 13 versus number 7, right? So in other words, I now know when looking at FKLI, if you were to use the techniques I use when it comes to trend assessment, you would know it's time to plan on a short. Of course, I totally respect and agree that there may be other trading styles in the room, and you may agree or disagree with my analysis, and maybe you have another way to assess it. Maybe you, again, there are a million ways on how to do this. I just want to give you different colors, so this lesson serves everybody. But for example, here we can see with CCI a bearish divergence. higher high and lower high, where we have high and higher high. So that's a bearish divergence. So again, if you're a CCI guy, you may have also agreed with me that maybe it's time to plan on a short, right? Again, totally agree. If you are not a CCI guy and you don't agree with me, no matter if I discuss it from the angle of CCI or I discuss it from the angle of photoclimate, again, this is what makes the market, people with different opinions. So totally respect that. This is not the point of today's webinar, by the way. So I'm just going to ask you to go with me in this practical exercise, if that's okay, so I can have my educational commentary here complete, right? So let's pretend you agree with my analysis, which is mine, and you now understand that shorting FKLI for an intraday trade makes sense. So now we go back to the 10-minute time frame that we saw earlier, and this would now be the time for you to begin shorting. Actually, as we speak, this was not here earlier. Actually, perfect. We just got a UFO form a minute ago, if I'm not mistaken, unless I didn't notice that UFO was not here earlier, which means that the technology just picked up on new sell-on field orders entering the market, okay, which is nice to see. So maybe you take a short and your stop is going to be here, okay? So entry right here, stop above, okay? So stop, entry, and then the green UFO. That would be your target, okay? Cool. So that's the idea. And again, how long would you now expect this trade to last? Okay, because we're talking about trading styles today. But again, if I go back to my 2-hour time frame, in this example, and we now expect a movement to the downside to happen, and we now expect, therefore, these blue dots to become red in the following candles, we know that the statistical duration of a down climate is 4 candles, where each candle is 2 hours each. So in other words, we are positioning ourselves out of a 10-minute trade for a trade that may last up to 8 hours as this market is going down. That's the expectation. And that is how I draw my trading style out of the timeframes I selected, quite randomly, to be honest, because I wanted to produce a different example compared to the one of the slides. I assume that everybody has a trading plan, and in your trading plan, if you don't have it yet, you will indeed have the set of timeframes that you utilize in your trading. If you don't have it yet, that's a must, okay? You need to have that. Yeah, anyway, so hopefully this example is useful. And then as the time is going fast, and I'm checking the time, so if I go back to where I was before, where we had 4 charts, right? In this case, we look at FCPO on the daily time frame, and we look at FCPO on the 4-hour time frame and FCPO on the 1-hour time frame. And here, let's go ahead and get the 8-minute time frame. Okay, so 8 minutes, 1 hour, 4 hour, 1 day. Okay, this is what I had on the slides, I believe. I'm happy to change the time frames later and do other exercises. So here in this case, what I would like to pretend, I'm going to maximize the 1 day. So this is the 1 day time frame of CPO. And here I'm going to use a collection of moving averages. Okay, so I got the 20, 50, 100, and 200 moving average. And something that could be useful to do here is to project this information from a daily time frame into other time frames. So what I want to do is, wherever my averages are, I'm going to draw a line. So black line right there, another black line right here where the next average is, another black line where this average is, another black line where the last average is. Okay, those averages are out of the daily time frame. So I will restore the chart down. And now, when I maximize my 4-hour chart, notice I already got lines here in place. Okay, those lines are already in place. By the way, I didn't say that I'm utilizing TradingView. So when you go to the settings, okay, you could basically with those settings, okay, you could make sure that the lines that you draw in one chart project into other charts with the same symbol, which is convenient. So what I'm going to do with the 4-hour time frame, I'm going to do the same. I will turn on the moving averages, And notice, okay, notice how, I'm just going to change color just so that way we are clear. So I'll do this one purple, for example. So notice how the purple line and the black line coincide. So there is a 4-hour average that coincides with the daily average. Okay, then there is another one here. It means one right there. That's another average right here. And then another one, which is much lower. So now I got 2 colors for 2 time frames, and I got 8 lines. Notice that those 2 lines are basically together, which potentially make them more relevant. Now I'm gonna move back to the 1-hour time frame. And I got my lines here, the purple, the blue ones are here. So now I will turn on the moving averages, and I'm gonna do the same thing. I'll pick one of the purple lines. I'm gonna change its color to, let's call it blue. Okay. And now I'm just gonna put those lines where the averages are. So there's one average here, one average here, one average here, and one average here. Okay. Yeah, and you can see how those lines are obviously relevant. They are, I mean, this is coming out of technical analysis, right? So price reacted to the average right there, price reacted to the average right here. So obviously, as we know, these lines are indeed relevant, which is why I am projecting information from these timeframes into another time frame. This was the concept of aggregating timeframes earlier. And then finally now, I am looking at my 8-minute time frame. That would be my trading time frame. And here I can see where my execution points could be, knowing that if that market was to rally all the way to 48.92, probably I have the highest probability trade at these price points because I would have multiple moving averages helping me here. Okay, so again, this is assuming you are a trader who trades FCPO, who utilizes the daily, the 4-hour, the 1 hour, and the 8 minutes, and also that you are a fan of moving averages, because maybe that is not you. Okay, but I just wanted to give you this particular example. Now, what if you are an FKLI guy? Okay, you trade FKLI, and instead of trading the 8, you trade the 13, and instead of trading the 1 hour, you trade the 4 hours, and on top of that, you are not into moving averages. And instead of the 4 hour, you use the daily. And as said, you are not into moving averages. And instead of the daily, you use the weekly. So what if we bump all the time frames up? And you happen to be a Fibonacci guy. So what can you do? Okay, so maybe you would take your Fibonacci retracement drawing tool, and here's the last obvious leg that took place in the marketplace. I'm going to select my magnet here, so my precision is complete. So I am coming from the bottom part of this week all the way to the top, and I got my classical Fibonacci retracement lines, so 0, 23, 38, 50, 61, 8. Okay, there are more, but those are the classical ones. So when I do that on the weekly time frame, restore the chart down, and go back to the daily time frame, notice that I get to see the lines here. But what else we see on the daily time frame? Well, on the daily time frame, we also see a very clear move starting from here. So maybe we're going to do the same exercise on the daily time frame from here to here. Okay? And then what? We're going to go back to the daily time frame. Okay, and on the daily time frame, we can see how the market is moving down. So let me compress this a little. No, yes, very good. So I'm going to catch it from the top. Okay, I'm going to go from here, from this top wick, all the way to this bottom part. Okay, and when I do this, and I go back to my 30-minute time frame, let's maximize. This is now the 30-minute time frame. So what do we see? Well, in this case, we don't see too many of these fib lines that are too close to each other. The only ones, and again, each market condition is what it is. I'm using live data, so it's what it is. But we can see that these two are fairly close. So again, if you were to be the trader, maybe your trading style involves a bit of patience and wait for this market to rally, which to be honest is fairly far in this case. And when price comes here, this would be the price point where you would take a short, okay, expecting the market to go back down. So maybe this is going to be your trading style, or maybe you have other rules in your plan, whereas when you only have one fib, you execute with half of the size. When you have nested fibs, you double the size of your trades. So you are willing to take a bit more risk as you may have more evidence for relevant price points. Again, I will leave this open to you because, to be honest, this is not a topic for today, even though I could not help to make this comment. So, yeah, basically, this is what we're discussing today, right? So the use of the timeframes in line with the definition of your trading style, which, as we said, is really critical. Not utilizing the right type of timeframes will put you in a position where you trade in a way that is uncomfortable. And uncomfortable is not only about you're not comfy on your chair. Uncomfortable means that you may miss opportunities because you don't trade at the right time of the day. Uncomfortable means you may get emotional because you didn't have enough time to plan your trade and you had to rush it and then it's moving against you and now you are in revenge mode. You name it, right? So identifying your trading style, it's extremely critical. The timeframes will allow you to adjust your trading activity to your convenience, which is extremely important. And then, of course, all your trading rules and your trading plans and so on will basically either approve or discard the trades. But not having that component of having thought about what type of trader should you be and use the right type of timeframes and ideally combine the information that you get from different timeframes into your execution timeframe, probably will work less well versus making sure that you're using various timeframes in your trading and they are relevant to you and your style, and you transfer knowledge from one time frame into the other time frame to make your trading methodology more robust through confirmation, through a confirmation type of approach, like I have done, where we ended up with certain lines that were near to each other, kind of confirming this price level was relevant. So with that said, I believe I hit it exactly on time by just a few seconds when it comes to reaching the break time, not for us to break, but for us to break 4 questions, which is probably the richest part of the webinar today, as really the webinar is about you. So beyond the lecture I just delivered, I cannot wait to understand where you're at and how can I help best.
Right. Thank you, Jose, for your informative sharing. I'm sure our audiences here has gained a lot of valuable insights into the different types of trading styles, time frames for trading success. And before we enter into our Q&A session, if you have any questions related to Jose's presentation, please type a question in Slido so that I can easily capture and address them. While we wait for questions to come in, I'd like to ask a small favor from all of you. Now, please take a minute to fill out our feedback form since we have provided an informative session today and it will take you less than a minute to complete. You can find the feedback form link in the chat box or scan the QR code with your smartphone. Taking a quick minute to share your feedback will greatly help us improve our future sessions and ensure we continue to deliver a valuable content that enhances your learning experience. So please take 1 minute to complete the form and we will begin with the Q&A session shortly. Another 30 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, thank you very much. For those who haven't finished yet, you can continue to do so. Now let's move on to the Q&A session. To ensure we cover as much question as possible, I will select the most relevant questions from Slido and rephrase them for clarity. And please understand that due to time constraints, we may not be able to address all questions. So Jose, here are several questions for you. Now, the first question, earlier you spoke about trading style. How can we identify our individual trading style specifically?
Very good. Very good question. Earlier in the presentation, I used a keyword, which is I used the word convenience. And what I mean by that is that, again, first of all, I did emphasize on the fact that trading is an emotional game. And therefore, if you were to trade in a way that is uncomfortable, that would be problematic for sure. So the concept of convenience in this case is not to be comfy in the sofa when we trade. Nothing wrong with that. The concept of convenience here is basically finding a trading style that allows you, or a trading style that you could implement with complete focus and relaxation. This has to do with things such as your trading hours in the day. So when do you trade? Of course, many of the markets that we trade many hours a day. So I guess it should be easy to find, but you should have a routine where there may be a specific time of the day where you can find this, comfort, peace of mind, level of focus, convenience I mentioned. So this is a key element of selecting your trading methodology, right? Other elements are directly related to your account size. So for example, each futures contract, for example, has a different point value or tick value, isn't it? So if the tick value is very large, of course, you also need a larger account size, but maybe not, because certain products are less volatile than others, right? So maybe you are trading a product that is not too volatile, even though the point value is high, and you can still trade it with a smaller account, or vice versa. Maybe you're trading a product with a small point value, but is very volatile, moves many points every day, and therefore you do need a larger account to trade it. Why volatility and point value will dictate how much money you need to trade? Because when trading, you will have to decide where is your entry and where is your stop. And that distance between entry to stop will be more the more volatile the asset is, and the ringgit value of that distance in pain would be more if the point value is more. So in other words, if the asset is very volatile and the point value is more, you will require more money to trade it. The opposite is true. If the asset is less volatile and the point value is less, then you need less money to trade it. That's obvious, and that, by the way, is not related to trading style. Now, why am I explaining this? Because to relate it to trading style and to answer your question, you also need to understand that a moment ago, I did mention that the distance between entry to stop dictates your risk, your loss in ringgit, right? The distance between entry to stop. What if you trade a market on a 5-minute time frame? Well, if you trade a market on a 5-minute time frame, that distance is going to be less. What if you trade a market on a 1 hour, 4 hour, 1 day time frame? That distance between entry to stop is going to be more. Therefore, you have to take more risk when you trade a larger time frame, and therefore you require a larger account. You have to take less risk when you trade a lower time frame, and therefore you require a lesser account, an account with less capital. So in other words, factors that dictate your trading style, as I said, convenience. your availability for time, your training psychology, are you patient or not, that kind of thing. Other factor, the capital you have available to trade, because maybe you will want to trade a larger time frame, but you cannot because of capital constraints, and you have to trade a lower time frame. Those are the main decisors when it comes to your trading style. Those are the main decisors. Another one I will add to the list, if you were to perform multiple styles of trading, is that you may trade intraday on purpose because you are already trading other markets for swing trading or position trading, and you want to create diversification from a time exposure point of view. Beyond diversification per asset, you may want to diversify based on time exposure. So that could be another one. But the two main important factors, as I said, is capital, as well as, I'm summarizing it by saying, convenience.
All right. Another question which also relate to both time frame and trading style. The question is, how do I choose the most suitable time frame for my trading style?
Very good. Typical question. You may not like the beginning of my answer. A little bit of a note of humor. I'll give you a complete answer for sure. But again, let's be realistic, okay? And now I'm getting serious again. Let's get realistic. There is no sure thing in trading. In trading, it's all about probabilities. It's all about taking a decision with risk management in place, where if you're wrong on that decision, you can survive the loss you have collected. And if you're right on that decision, you do better than the risk you took, right? This is trading. Probabilities, risk, and reward. There is no sure thing. So because there is no sure thing, I cannot tell you the best time frame to trade FCPO is the 10-minute time frame, or the 15-minute time frame, or the 1-hour chart. There is no such a thing. The real question and real answer would be, what is the ideal time frame for the style I decided I want? That would be a question, if I may say, just a little bit more complete, if you don't mind me to add that to your question, while your question was good. It's a bit more complete because now you are giving me an indication of the duration of your trade. So if you told me, I want to be an intraday trader, I want my trades to last maximum an hour, of course, you have to stay within very low time frames, right? And therefore, the best way to decide which is the best time frame for you is not going to be because I throw a number at you or because you read it in a book. The best way, if you're serious, if you're a professional, the best way to find out what is the best time frame for you for the trading style you decided, which is out of your capital and out of your convenience, right? The best time frame will be that you implement your trading strategy with 2 or 3 time frames, maybe 5 minutes, 10 minutes, 15 minutes. If you decided you want to be short-term intraday, you implement that strategy, going back in time. This is called back testing. You collect a significant amount of samples, and then you compare. And one time frame may show you significantly better results than another. Then you will know this time frame tends to work better. And the reason why one time frame may end up working better may have to do because it's aggregating more trading activity in certain times where trading volumes are low. I mean, they are trading, for example, at this hour of the day, you could imagine FCPO volumes or FKLI volumes are not at this peak compared to in the middle of the morning hours. Correct? So again, not every candle in a chart has the same weight. So when you change timeframes, you may get a little bit of better results because you have more of an aggregation throughout the time where, you know, the information becomes a bit more relevant from a volume point of view. So how do you know that? You have to backtest. And by the way, these may change through time. You may be trading a specific time frame with an expectation of certain performance, and next thing you know, you may notice next month that, hey, you know what, I'm performing a little bit different this month. So then a healthy exercise to do is to rerun some backtest on various time frames, and you may conclude that, look at that, most volume now is moving into this other time frame, maybe I should switch. Okay, so it's a dynamic thing. The markets are dynamic. Unfortunately, I could not answer your answer with an absolute, like the best time frame is this. That's the real world of trading, and hopefully this is an answer that makes sense to you.
All right. There is one frequently asked question, I believe as well. Which trading style would consider as least risky?
Very, very good question. I'm very happy about the questions today. Those are very good questions, meaning that the attendees, the students, the traders asking such questions, they are really thinking seriously about trading. I love it. So look, we have to define risk to make sure that we mean the same thing when we use the word risk. If you say that to you risk means the probability by which you may get emotional and start making human errors when trading, then lower time frames, intraday style, is riskier because you're going to be executing many times a day. What if you collected 3 winners in a row? Now you're euphoric. What if you collected 3 losses in a row? Now you are fearful, or worse, in revenge mode. So that is obviously source of risk. And if that's your definition of risk, then the intraday timeframes are riskier. Now, if your definition of risk is gap risk, what if I close a trade with FCPO and it closes and it reopens with a gap a few points down, and that surpasses my stop and I get 20% more loss than expected on leverage? That's risk. And that would only happen if your trades last more than a day, meaning that you're using maybe 4-hour charts, daily timeframes, and things of that sort. So if your definition of risk, of your concern, has to do with overnight risk or gap risk, then trading intraday is less risky. Does this make sense? So it's a difficult question to answer because we need to speak the same language when it comes to what risk is for you. To me, and this is just a bit of personal preference, and therefore this answer is biased, I have to say, because it has to do with my personality. So take it like that, meaning that you don't have to agree with me. Maybe you actually think or feel is the opposite, which could make sense. So in my case, I am very patient when it comes to waiting for a good trade to happen. But once I'm in a trade, I am absolutely not patient to get out. So because of that, I love to do intraday trading. And I see my entry and my stops are going to be near. So my points risk is a low value because the stop and the entry is close. Of course, if I use too many contracts, then the risk is high in ringgit. But in points, the risk is low. So in that sense, since I'm going to get to see whatever happens quickly because it's intraday, I don't have to wait too much to find out if I'm right or if I was wrong. I don't have the gap risk, and the distance from entry to stop is near. So then to me, that's low risk. But of course, you have the risk of human emotions if you are an emotional guy or you are newer to trading and you are still working on developing the trader mindset, right? So there is no black or white. It's a collection of grays in between. It depends on where you are in your cycle and what are your priorities and what is your definition of risk. But hopefully my answer makes sense to you, because I'm sure you were thinking about risk your way when you ask. So hopefully my answer answered what your concern was about. If not, please type again on the chat box. I'm happy to clarify further.
All right, great. There is a question about multiple time frame. So the question is this: how can we do multiple time frame analysis to make our trading decisions?
Very good. So when it comes to mixing timeframes, I will tell you, I will go from extreme to extreme, what is right and what is wrong, right? So what is wrong is, for example, here you go to the drop-down. Actually, I'm not sharing my screen, so I'm going to use my words to explain it. What is wrong is that you go to the drop-down menu on TradingView or your trading platform, and you may have 15 or 20 time frames, the 1 minute, the 2 minute, the 5 minute, the 10 minutes, the 15 minutes, the 20 minutes, the 30 minutes. And basically you do your analysis with all those time frames, and then you want to conclude something about trading. So this is what I would call the hyper perfectionist approach to trading, where you are trying to find this one answer, where basically you are looking for certainty. Okay, this is definitely a mistake I made myself at the beginning of my learning curve, maybe because my background was engineering, and of course, as an engineer, you look for the sure thing. Well, in trading, there is no sure thing. So if you were to do this exercise of going through 20 timeframes and do your analysis and combine the information and aggregate, as we commented today in the webinar. And let's say you found the trade of the century and you took the trade and you got stopped out because the future is still indeterminate, right? The future is the future. So what will happen to you now? Well, the next step is give up on trading, right? Because you had this perfect, infallible trade and now you got stopped out. So what does that mean? Well, better stop trading, right? So it doesn't make sense to be perfectionist. That's my point, right? So what you want to do when looking for a combination of timeframes, you want to have a pragmatic approach where I would say my recommendation would be maximum 3 timeframes to plan your trade and maybe 1 extra timeframe, as I did today myself, to execute. 3 plus 1, that is the maximum. In many of my trading applications, I utilize only 2 timeframes. Why is that? Because if you use too many timeframes, you end up finding conflicting information. One timeframe will tell you the trend is up. The other timeframe will tell you time to be a seller. So now what do you do, right? So the best way to avoid contradictions is to have a limited amount of timeframes. You keep your process simple. You know you are dealing with probabilities and risk management. So if you get stopped out, you don't have this huge disappointment and you give up on trading. You just know you had probabilities in your favor. Probabilities are not guarantees. The market went against you. You had risk management in place, maybe a stop. You're out. You can survive it. Plan a trade again. And that's it. That is my recommendation. So 2 timeframes, if you are very pragmatic. 3 timeframes is the normal thing to do. Maybe 4, definitely more than that, I would think is overthinking and being too much of a perfectionist, which I could understand. I was there myself, but not useful. And which timeframes to use? Well, I gave you a table in the presentation, isn't it? So that would be the classical set of timeframes I would say I would recommend as a good beginning, in the sense that it's used by most traders in the industry. So why not yourself?
All right, there is a question related to multiple trading styles. So the question is, will there be any potential risk or problems when combining multiple trading styles?
Yes, of course, especially if you do it in the same account, right? So if you are, let's say you have a policy that says I'm going to risk 2% per trade, but now you are doing that times 2. So really you're risking 4%. You may say, look, the assets are non-correlated, so I'm diversified. So if I make money in one, it may mean I get stopped out on the other one. And if I get stopped out in one, it probably means I'm going to make money with the other one. So I'm fine. I'm going to double my risk. Well, no, because on top of all of it, you have something called Murphy's Law, which means that no matter the correlation, you may have 2 markets go against you at some point, and it will happen. I mean, this is one of the few times I would say guarantee, right? It will happen that you take 2 trades in parallel and magic, both of them move against you at the same time. That will happen. So you have to work very diligently when it comes to your positioning, to your risk management. If you're going to be doing that with the same account, make sure your position size is adequate, thinking of what if I get stopped out in all trades at the same time. That should be your risk management approach. What is my worst case scenario? Okay. There are advanced applications. Unfortunately, we don't have the time to discuss it properly, but I will throw the idea out there. So hopefully food for thought, and you can think about it. There are ways on how to trade where instead of utilizing entry, stop, and target, like I have discussed today, you may use entry and stop, and then target 1 and target 2. And your target 1, you could place it very near to your entry and unload enough contracts at your target 1, whereas you remove the risk of the trade completely. So if you do that, let's say, for example, you take a trade on FKLI, target 1, target 2, a few minutes after, target 1 is hit because it's very near. So the probability of being hit is high. And when that's going to happen, typically happens quickly. If not, you get stopped out. So the moment you get to target 1 on the first trade, let's say FKLI, you're out of most of your position. So you have no more risk, just a few contracts left, but most of the position is gone. So no risk is left on that FKLI trade. So what do you do now? In parallel, you take full risk with FCPO, for example, and now you're running two trades in parallel, knowing that the total risk is one trade, it's not two trades. So you could do that. You could work with scaling in and scaling out methodologies that allow you to remove the risk of trade number one. So when you get into trade number two in parallel, you don't have the full risk. Of course, this becomes more complex to manage. It's indeed more sophisticated. It for sure has its advantages. Again, exceeds today's presentation objective, even though hopefully it got you thinking and you can do some research on your own. And hopefully that helps as an answer, even though I cannot go deeper into it.
All right, because of time, we are going to take one or two more questions. Now, there's a question that is asking about, for being a part-time trader, what would be the most suitable or successful trading style that is highly proven to be beneficial for a part-time trader?
I will give you an answer that starts with it depends, and I have to say it because it does indeed depend in the real world. So again, real world approach to trading, real questions, real answers. So what do I mean by it depends? Well, it depends if your definition of part-time means that you have limited time to trade, or maybe part-time means that you look at the markets on the weekend and you take an execution during the week, for example. So those are both part-time, isn't it? But what a very different scenario of being a person who looks at the market over the weekend versus a person who trades every day but limited time, right? So I would assume you probably mean the guy who trades every day for a limited amount of time. I would assume you mean that, but I did want to add the other side of the it depends, because some of you may be less active and look at the markets over the weekend, and that's definitely also a valid way on how to trade. So if you were to be a trader who is trading part-time, such as you have limited time to trade every day, but you want to trade every day, then really you have no choice. You have to be an intraday trader. So very short time frames, 5 minutes, 10 minutes, things of that sort, in and out before you're done. And you may even need to have a rule, which is, okay, if the trade is not finished before it's time to go, I need to close the trade manually before I go. Because one of the very important rules for intraday trading is that you have to be out before the end of the day. So if you're not going to be there at the end of the day, to avoid gap risk, you have to close your trade. So diligently, if you have 1 hour to trade, it's very limited time, but if that's what you have, very short time frames to make your trades last little time. Take one trade, maybe 2 trades, done, that's it. So you have no choice there. If you have limited time, you have to be a short-term trader. On the other extreme, if you have limited time to trade because maybe you work in an office, but your approach to trading is, I analyze the markets over the weekend, I identify a key opportunity, I just place my order on Monday, for example, and I just review what happened during the week, right? So maybe now you can be using daily timeframes, weekly timeframes, and you are trading larger timeframes, and you just look at the markets in the evening because your analysis was done over the weekend. So this is another way to do part-time trading. And in this sense, to me, it would make more sense that you utilize larger timeframes so you don't have to rush into reviewing your trades, because you are a part-time trader, meaning that you don't have time during the week. You only have time to analyze during the weekend. So your only time to review is in the evening. So you don't want to have like an alert pop up on your phone in the middle of the day, and now you have to rush to do something to your trade, whereas you don't have time to focus because you are busy with something else. Therefore, for type 1 part-time trader, intraday trading would make more sense to me. For type 2 part-time trader looking at the trades over the weekend, I would think that utilizing larger timeframes is probably more suitable.
All right, thank you very much, Jose, for answering our participants' question. It's quite a long Q&A session. Now it's about time for me to conclude today's webinar session. Now, as you may have already know that today's webinar marks the final session for this year, 2024, and we truly appreciate your participation throughout the year, and I hope that you have found our sessions insightful and valuable. And looking ahead, we are excited to announce that our upcoming webinar series will begin in January 2025. And be sure to stay updated by visiting our website's event calendar, where we will be posting about future webinars and online workshops. As for those of you who may have missed the earlier announcements, let me share with you again our upcoming final LLF online workshop for the year. Now, this workshop is tailored for those who are new to futures market. If you are interested in learning about futures trading in detail, then this online workshop is ideal for you. Now, you can take a picture or screenshot this page and register yourself after this webinar ends. And feel free to share this event with your friends and family who are also interested in futures trading. Now, this upcoming Saturday is our final LLF online workshop session for the year that it will be conducted in English. We will guide you step by step on how to start trading your first futures contract. And do know that each session is limited to the first 50 online attendees. So be sure to register yourself quickly to secure your seats in both workshops. Once you scan the QR code, you will be directed to a page where you can access our event calendar. To find the online workshop session, look for them in the Saturday column. Click on the workshop session that you're interested in and proceed with your registration from there. Bursa Malaysia has a website called Bursa Marketplace where you can explore a derivatives trading simulator. This simulator allows you to engage in paper trading, helping you to familiarize yourself with using a futures trading platform. You can register a risk-free trading experience and give it a try to start developing your interest in futures trading. So it's a great way to learn and gain hands-on experience through this trading simulator. Finally, before we conclude this webinar session, allow me to introduce you to Bursa Academy. Bursa Academy is a comprehensive one-step e-learning platform where you can access all the information and knowledge about stocks, futures, and other products traded in Bursa Malaysia. You can access Bursa Academy by scanning the QR code on your right or by searching for Bursa Academy on Google to find the link. You can visit this for more detailed information and resources. It's a valuable resource to enhance your understanding of trading in Bursa Malaysia. All right, we have come to the end of our session today. Thank you, Jose, for sharing with us such an informative session. And to all of you who joined us, thank you for your participation. We hope you find this webinar both informative and valuable. I believe we have gained new knowledge in how to trade the futures market better. And once again, thank you for being part of our journey this year. And we look forward to seeing you in 2025. Have a great day and good night.
Thank you so much, CY. Pleasure, and thanks everybody.
Okay, bye-bye.